a lot of the issues in sort of the regional areas that are popular amongst holiday goers is not only are these, rental properties taken out of the market and then sold to owner occupiers, but they might be sold as holiday homes, but they're also been putting on Airbnb. There's the short-term rental market as opposed to the long-term rental market.
What I'm finding with the rental market, probably the standout metric there at the moment is a lot of the high vacancy rate areas starting to look better.
Yeah.
They're improving.
Yeah.
So I think that'll have a flow-on effect to everything. So these pockets of high vacancy rates, such as your Docklands, such as your Melbourne Inner, etc., are all looking better. So I think the heartache of a lot of the inner city high-density investors will start to ease a little bit now.
Well, I'm presuming that's because the borders are open again and, we're looking at overseas students and immigration. So, and typically a lot of those people would go to those type of properties, right?
Oh, well, I think that you'll flow to where the properties are available. You don't have
Absolutely.
You don't have schools to worry about. You don't have a job yet.
It's a good point though, Ken. If you can't go rent a property in an area that you really want to be, you'll have to go where there's properties available. And, if you can't rent that, maybe it's for socio-economic reasons or something, you have to go to an area where maybe it's a bit cheaper and and it's easy to rent. And this is where you get a different type of demographic shifting into these areas. And that's sort of what happens, right? And then more and more housing stock come on. So we've got to be very careful that, these suburbs don't become areas where the socioeconomic starts to deteriorate and you get this more supply and then it's less desirable. And then if it's less desirable, then all of a sudden you've got this pocket where people don't want to live, but there's lots of housing.
When you look at things such as the leading indicators such as vacancy rates or inventory, so vacancy rates versus rent price movement or inventory versus house price movement or sale price movement, the CEFA index does show up very differently. So if you've got a lower socioeconomic area, all things equal, generally those that have had the CEFA index 8, 9 or 10 have been the ones that have had the steeper reaction in terms of a tight market, bigger price increase. Whereas you've got some of these areas that are lower socioeconomic, doesn't matter how much the vacancy rates reduce, prices have only been marginal in their rise because people can't afford to give you an extra $200 a week. Now, for those people though, an extra $20 or $30 a week, that's a lot of money. So it's interesting to see the market dynamics and how much I've learned in the last 2 months just observing, because everywhere is just almost that in one fell swoop we've had a similar impact in terms of vacancy rates trending down and low, inventory trending down and low, and now we've got a method to kind of categorise and understand the dynamics of each market and classify them. So you can pull them out and say, look, the markets that are higher advantage markets behave very, very differently.